Hello and welcome to Moving the Metal, the premier legally focused podcast for the auto finance industry. I'm Brooke Conkle, a partner in Troutman Pepper's Consumer Financial Services Practice Group.
And I'm Chris Caperso, an associate in Troutman Pepper's CFS team.
Today we are joined by Jason Cover, and we will be discussing refinancing and its impacts on the auto finance industry. But before we jump in, let me remind you to please visit and subscribe to our blogs, TroutmanPepperFinancialServices.com and ConsumerFinancialServicesLawMonitor.com. We also have a bevy of podcasts that may be of interest to you. The Consumer Finance Podcast, which, as you might guess, is all things consumer finance related. FCRA Focus, a podcast dedicated to all things credit reporting. Unauthorized Access, a deep dive into the personalities and issues in the privacy, data, and cybersecurity industry. And finally, Payment Pros, a great podcast focused exclusively on the payments industry. All of these insightful shows are available on your favorite podcast platform, so check them out. And speaking of those platforms, if you like what you hear, please leave us a review and let us know how we're doing. We'd love to hear from you. Alternatively, feel free to reach out to us directly. Our contact information can be found on our firm's website, Troutman.com. If you enjoy reading our blogs or listening to our podcasts, please also check out our financial services mobile app. To download it, go to your iOS or Android app store and search for Troutman Pepper. Not only does our app have all of our blog content and podcast episodes in one handy place, it also has a listing of all the firm's financially focused attorneys. So check it out and see what you think. Today, we'll be discussing refinancing and its impacts on the auto finance industry. Jason, welcome to the show.
Thanks, Brooke.
So before we get into the many questions we have for you, Jason, could you just tell us a little bit about your practice?
Sure. Thanks, Chris. My name's Jason Cover, and I am a partner in the Philadelphia office. I'm in the CFS, what we call regulatory group. So I primarily focus on the alphabet soup of federal and state regulation and work a lot on product design and generally helping clients find innovative solutions to complex problems.
Great. With that kind of intro, we're going to dive right in. And as Brooke mentioned, we're going to be talking about refinancing. But at a very basic level, one of the things I wanted to get at was in auto finance, we see a lot of what are called retail installment sales. And yet with refinancing, we're talking about loans more often. And Jason, I was just wondering, what is the difference between a retail installment contract and a loan?
Chris, I think most of us sort of inherently understand what a loan is, right? It's at its most basic form. It's a cash disbursement that's payable over time, usually with some sort of finance charge associated with it, whether that's interest or something else. And I think if you go to any of the conferences us consumer credit nerds go to, you'll invariably hear someone say, that credit has been around since biblical times and usury is documented and so on and so forth. Whereas credit sales or retail installment sales or retail installment contracts, whatever you want to call them, I think both clients and internal colleagues sometimes struggle with that concept. This is more of an English common law concept that's been codified in various, states. But at its core, it is essentially the right of a seller to set its price and defer payment over time. In most states, there is common law, case law stating that kind of concept is not subject to usury and is not a loan. It's a credit sale, and it was often deregulated. And I think then you saw like a trend in the 60s and 70s, particularly as department stores started offering revolving credit accounts for sales at their department stores. I think nearly every state, except maybe New Hampshire and a handful of others, adopted some sort of retail installment sales act. And then some states have also adopted specific motor vehicle retail installment sales acts. And generally, these things kind of codify the types of goods and or services that are subject to the act, so that if you have a seller selling any of those goods, they may have limitations and not interest typically. I mean, they may call it interest, but the common law phrasing is time price differential. So that's sort of the finance charge for a credit sale. And I guess critically, I kind of think of these in two different ways. Like a loan, it's sort of like a tripartite arrangement, right? Where I want to buy something, I speak to a seller, and then we go and find a lender, right? And I agree to pay the lender the amount, the seller gives me the goods or services, and then the lender disperses the funds directly to the seller. In contrast, a credit sale is sort of like a linear flow almost, right? I'm a buyer. I speak to the seller. I want to buy something. And the seller says, great. They originate the credit themselves in the form of the RIC or the retail installment sale agreement, whatever you want to call that. And then they may pass that along to a holder or a sales finance agency that purchases that RIC for amount, either the full price or at a discount. So it's just a little bit, I think the eventuality is largely the same, but it's a little bit of a different structure.
Yeah. And in auto finance, most people are probably going to be dealing with some form of retail installment contract. I mean, you think of the dealer and then they assign it to insert your manufacturer, auto finance or finance company or whatever they are. That's usually always the consequence of a retail installment contract where the seller is the original creditor and passing it off. But then you could have scenarios in the original buying where you go to your credit union or your local bank or something like that. And like you said, get the proceeds to go pay for it. And then at that point, you've bought the car and then you have a separate financing agreement with whoever gave you the loan, whatever entity.
Yeah, I think that's right, Chris. I mean, I think the vast majority of car financings in the US are done through the credit sale or retail installment contract model. And that isn't to say that you couldn't do it through a direct lending model either. It's just not set up that way for the most part. I know, we have clients in the business that just don't do, no loans at all. I've talked to some of our clients that may offer loans, but to your point, it's usually a de minimis portion of their overall volume.
What are some of the state law considerations for loan programs that might be different from a retail installment sales contract finance operation?
Yeah, Brooke, I think one reason some of our clients like to use the credit sale or RIC model is that generally speaking, at least at the state level, I'm kind of excluding, banks out of this that may have much more liberal rate authority and so on and so forth. But generally speaking, the state laws that govern RICs tend to be more flexible. They tend not to require as much licensing. Often rates and fees are much more deregulated. And there tends to not be as much direct supervisory examination at the state level. In contrast, the lending world, almost every state, particularly if you go beyond a certain rate trigger, will require a license. You'll be subject to routine examination or supervisory authority. Most states are going to have some sort of cap on the types of finance charges, on the way you impose finance charges, on various fees, et cetera. There could be periodicity or substantially equal payment amount requirements. So on the whole, I think the RIC RISA world is just a little bit more, there's just not as much governing it. Whereas anytime a loan is involved, there does tend to be more, and there tends to be more supervision at the state level. I do think that in some ways there's been an explosion of growth in the RIC model, outside of traditional auto finance. So that this is maybe a little bit more on the radar than it used to be, but those laws generally remain the same. And I guess I would add there's just kind of like two primary attacks on both of these types of products. So for credit sales, the plaintiff's attorney or a regulator that doesn't like your transaction may try to recharacterize a credit sale as a loan, right? They're essentially saying, well, you weren't really the seller in this transaction. It was really the sales finance agency. Therefore, it should have been, it's essentially a disguised loan. This is just what anyone would do to try to take advantage of a statute that's more favorable to a consumer. You'd want to try to recharacterize the credit sale as a loan. In contrast, for lending, there's this concept of dragging the body. So that's essentially, I think the traditional model was like at the dealership, right? There would be a hut or something across the street, and they would literally drag the body across the street and say, have we got a great loan for you? And that may have been because it was more advantageous to lend in that state than to do the RIC model or for other reasons. And that's just kind of the flip of recharacterization, right? Of the RIC as a loan. Now we're going to try to recharacterize the loan of the credit sale, essentially saying that the seller was really the lender and it was a sham.
That's an interesting point on recharacterization, because speaking to an auto finance audience, we're talking about potential recharacterization of a credit sale into a loan. And then there's some instances where there could be recharacterization risk of a lease into a credit sale. You kind of go down the rung of deregulated products.
Yeah, I think plaintiffs' attorneys and regulators are always clever. So they will figure out whichever is the best way to attack something and proceed from there.
Predictable in that sense. So we're talking generally about RICs versus loans, but are there any differences or other considerations for refinance transactions specifically between loans and RICs?
Yeah, I think for loans, Chris, I mean, a refinance transaction on the whole is pretty simple, right? You sort of add that extra box to your TILA disclosures and about amount credited to your account. And largely, you proceed from there. I mean, most licensed lending statutes, I would say, specifically authorize refinance transactions. There may be some timing limitations, right? I think this is generally more applicable to small dollar statutes, but there may be something there that X amount of time has to go from origination until you can refinance. And then there could be restrictions on the types of things that can go into the refinance transaction, like can principal, interest, and fees all get spooled into the new principal amount? But largely, it's pretty cut and simple once you're a lender or a licensed lender, and you don't have to worry too much. For RICs, I think it does cause confusion, right? Because we get back to that concept of a seller originating the credit, the extension of credit to finance the car. And once that's passed to the holder, it kind of raises the question of, okay, well, when you refinance into another credit sale, what does that mean, right? Are we the seller anymore that has the ability to do this in a new credit sale? Does it has to be refinanced as a loan? You kind of have to address that initial concern of what is the transaction and is it appropriate for wherever the paper is at that point. And then I think if you look at the Retail Installment Sales Acts or the Motor Vehicle Retail Installment Sales Acts, there's usually very specific provisions about, I think, like modifications or add-ons or refinance transactions generally that may be more specific than in lending world. So you really have to sort of hone in on the state requirements about how that works and who can do what.
Jason, in the current climate, we're seeing just higher and higher numbers of consumer delinquencies in auto finance. How can auto finance companies use refinance programs to try to stem this tide of delinquencies?
Yeah, Brooke, I think the easiest use case, right, is what a lot of people use a refinance for is essentially to lower the payment amount, right? So, I mean, this could happen not just in auto, but in mortgage or wherever, right? I'm currently paying a lot of money and I'd like to pay less. So you can obviously use a refinance transaction in that sense. I do think you have to give a little care and concern when you do that, right? I mean, the use case that's raised often by consumer advocates, regulators, and others is like rolling over. And I think this happens more in traditional installment lending, but rolling over transactions over and over and over again to get insurance money or to get origination fees, things of that nature. So you need to A, be a little bit careful there. And then B, you need to give a little consideration into the appropriateness of the refinance transaction, right? I mean, are we going into a higher rate over more time, particularly for like an auto transaction? You know, there may be a point where the loan is so long that it doesn't make a lot of sense. I think that has been, or the refied credit sale, there's been criticism sort of where these loans and financings get longer and longer, that they sort of get past the useful point of the car, et cetera, et cetera. And then I think you just need to be careful anytime you're taking a lower APR into a higher APR and suggesting to consumers that that's like a good deal or it's appropriate for them. But I think there's obviously other guidelines and you need to make sure you check all your boxes for state law and whatnot. But I think that to me is kind of the use case, but you need to give consideration.
Yeah, we'll probably be seeing, shouldn't say probably, hopefully with fingers crossed, hopefully be seeing some lower rate environments here soon, which is what seemingly a lot of people in the mortgage and auto industry are hoping for. But kind of going on that point and what's coming in the future, what are some things that we should be watching out for and auto finance companies should be watching out for in the next year, specifically related to refinance?
I mean, I think you hit the nail on the head, Chris, is like what's going to happen with rates in the next year. I think we've all been waiting with bated breath for all sectors of the consumer finance. And I think all finance generally, whether it's commercial or consumer, everyone is sort of sitting on their hands patiently waiting for the Fed to drop rates. I kind of think that would potentially unleash a wave of refinance transactions. I'm sure it will in mortgage world, particularly, right, where people have been probably paying more than they want for housing and you would like to get lower payments and a lower rate. And I think that equally applies to auto finance. So I think if you said pick one thing, that would be the thing I would be watching for.
Awesome. Well, thank you so much, Jason, for coming on the podcast today and educating us all on RICs versus loans and the benefits of refinancing programs. Don't forget, this isn't directed to Jason, this is directed to all of you. Don't forget to check out our blogs where you can subscribe to the entire blog or just the specific content you find most helpful. That will be the Consumer Financial Services Lawmonitor.com and the Troutman Pepper Financial Services.com blogs. And while you're at it, why don't you head on over to troutmanpepper.com and sign up for our Consumer Financial Services mailing list so that you can stay abreast of current issues with our insightful alerts and advisories and receive invitations to our industry insider webinars. And of course, please mark your calendars for a great new episode of Moving the Metal, which will release in 2 weeks. Until next time.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.